Hello everyone and welcome to our first webinar, taking you through the views of FX Talking, our flagship publication with all our latest forecasts we publish every month. So I'm excited today to be joined by key contributors in those publications, Francesc Taborski in the EMEA space, Francesco Pizzoli in the G10 space, and the Head of Research in Asia, Dipali Bhargava. So from my side, a little bit of admin first, if that's okay. If you'd like to drop questions to us, they will come through, use the tab at the top right for questions. They will come directly through to us. There's also an audience chat, but that sits in the public domain, so please be careful what you share in that public domain there. But without further ado, let's start off with a poll on Eurodollar. We've conducted these over the last couple of years, got some really interesting results. And if we could run that poll now, please. So we're asking, where do you think Eurodollar's going to end this year? You see the options there, above 120, 115 to 120, 10 to 15, 105 to 110, or below 105. And we'll come back to those answers a little bit later. But let's get straight to the issue. We've invited you to this call to talk about how far the dollar can fall. And I'm going to provide a little bit of context before then handing it over to Francesco to talk about how far in particular Eurodollar can rally. So just in terms of the dollar itself, what we have seen in the first 6 months of this year has been a very sizable move, about 10 to 12%. That's one of the largest moves we've seen this century. As you can see historically, 10 to 12% is a very big move. How have we got there? Well, if you remember back in January, February, it was a story of how there was a rotation from the US into international stocks. And remember how geopolitics played a role there as well. When, do you remember Pete Hegseth, the US Defense Secretary, was in Brussels saying effectively to Europe, you're on your own. That really spurned the defence expansion, the fiscal expansion in Europe. Eurodollar had one of the biggest rallies of the year in that period. We then, of course, we moved into early April, and a kind of Liberation Day. We saw the dollar, perhaps an act of self-harm, and the dollar fall very sharply indeed. And that, if you remember, we had the issue with regards to how the correlation with the dollar broke down between US Treasury yields. Normally high US Treasury yields are positively correlated to the dollar. That broke down. We moved into a sell America story. Obviously, very dramatic in terms of what it meant for kind of US price action. But since then, the dollar has reconnected with yields, and in fact, a more normal market. And then more recently as well, I think we've returned to, I would say, more traditional macro drivers for the dollar, where there's been focus on lower inflation up until yesterday. That was Fed easing, pressure on Powell to resign, that we'll talk about as well later. And the dollar has been weak, as I say, until the end of June, until we've got this kind of modest correction back. But I think it's probably important now to have a look at, in terms of answering that question, how far the dollar can fall. We use a scenario analysis here at ING. And I'm going to ask Francesco to take us through that scenario.
Yeah, thanks very much, Chris. So some of our clients might have seen this scenario analysis before. The way we structure it is that really we look at scenario number 1 and scenario number 4 being sort of the frontier ones, whereas the two central scenarios, we have our ING house view and an alternative scenario to the baseline. Now, since today we really want to answer the question, which is how far the dollar can fall, we'll look at scenario number 1, which we called run from the dollar. Now, we must make two considerations to start. First of all, the dollar is already embedding some risk premium. So some of the negatives are already in the price of the dollar. And the second consideration is what Chris was mentioning, which is that the FX market is now working in a more functional way. So, for example, the fact that we have seen a reestablishment of correlations between the dollar and the yield curve, the US yield curve, that is quite significant. So if you look at the first scenario, really, it's where we could see sort of a 2 standard deviation move based on implied probability from the option market. And this would be sort of like a scenario where euro dollar trades above 125, and it's sort of a repeat of what we saw in the first half of the year. Now, we really don't think that a couple more Fed rate cuts compared to what markets are pricing would be enough to trigger such a move. We think that on the Fed side, we wouldn't just need to see big cuts, but we would need to see markets pricing in some loss of independence. Could this be because Powell exits early, or because the Fed cuts so much the markets did not justify those cuts with sort of macro fundamentals? On top of that, we think we need to see more surprises on tariffs. Now, markets have clearly built some resistance to tariff headlines. So we think that especially with regards to China, Trump needs to deliver more surprises in terms of tariff hawkishness. And that can really lead to markets to sort of reprice growth expectations lower again in the Fed at a time where the feeling that the Fed has lost independence could trigger rising for sort of inflation getting a bit out of control. And so this stagflationary environment is what, in our view, we need to see to sort of see euro dollar trade above 125 by the end of the year. We won't go through scenario number 4, but in the second and third scenario, we have our house view and alternative scenario. Chris will talk to you about the house view shortly, but on the third scenario, which we call pragmatic Trump, is sort of an alternative scenario where Trump turns sort of looks at the inflation figures coming up. He decides to scale back protectionism, and then the reasons that have kept sort of euro dollar so high sort of start to disappear, and markets take euro dollar back to 110 with sort of growth expectations repriced higher in the US. But let's talk about our baseline scenario. Chris?
Yeah, thanks a lot, Francesco. Actually, before we talk about the baseline, I wonder if we can get the poll results up on screen just to have a little kind of comment there. Yeah, so actually, people have turned a bit more bullish than when we last had a poll, actually, in one of our other webinars in early June. Back then, we probably had about 60% of people looking for, actually, it was 57% for 115 to 120, and above 120 was 3%. So I think people have retained that bullishness and actually gone a little bit further in terms of a greater percentage now thinking we are going to move above 120. So perhaps not surprising, because at the time in early June, we were trading at 114. But that, I remember at the time saying that was one of the more conviction sort of views we were getting from our poll results. So people are bullish. In terms of our baseline view, in terms of Q3, I think we could call this a counter trend correction in euro dollar. And the reasons for that is mainly the Fed. We're just about to run into some higher US inflation as tariffs start to feed into higher prices. There was a hint of that yesterday in the June CPI, but we expect more of that to come in July, August, and September. And even though the market's probably about maybe 50% priced for a Fed rate cut in September, we think it'll be too early for the Fed to cut. So we think the Fed doesn't cut until December. At the same time, we're looking for the ECB to cut 25 in September. Probably like lower inflation in the Eurozone is going to come through, and let's see what happens with the tariff noise that pushes the ECB into taking rates below neutral, so below 2%. So a counter trend correction in kind of euro dollar in Q3, and then we'll be pushing back up to sort of 118 to 120 towards year end and higher into next year. And particularly into year end, remember the dollar is seasonally weak in December. There is going to be heightened speculation about who is going to replace Powell. Remember, the term of one of the Fed governors ends in January. So that'll be the first opportunity for President Trump to put in place a new governor that potentially could become the new chair. And so combining that all together, I think, and particularly with the Fed cutting rates 50 basis points and reducing those hedging costs. Remember those idea of hedging costs and the buy side increasing their hedge ratios on the holdings of US assets. that is going to be a dominant theme in for year end. And I think into 2026 as well, we will start to see the tailwind of the Eurozone fiscal expansion starting to show in the Eurozone data. So I think looking through the end of the year, things are going to be looking pretty good for Eurodollar throughout the whole of 2026. But on the subject of the Fed cutting rates, which might sound quite good news for commodities, I'm going to hand it back to Francesco to take us through quickly the commodity.
Yeah, I think if we look sort of 6 months ahead, commodity currencies, Aussie, Kiwi, CAD, they all look pretty good. However, I think in the short term, the picture is a bit more nuanced. As we discussed, we think that there could be some repricing in Fed rate expectations. The dollar could get a bit of a lift. And in particular, what we saw in Eurodollar, we saw it across G10, and that is that short-term rate differentials are becoming more relevant. Markets are looking quite closely at what central banks are doing about the tariff threat, how they're responding to downside risk for growth. And I think in that sense, we need to be a bit more selective in the short term. So, for example, we think the Australian dollar is in a pretty good position sort of to absorb any dollar appreciation because markets are already pricing in quite a lot of RBA easing, whereas we think that markets are definitely underestimating the chances of a cut in the fall by the Bank of Canada. And for this reason, we are actually quite bearish on the Canadian dollar. But I think an even more compelling story can come from the Scandinavian area, where we have two currencies, the Norwegian krone and the Swedish krona, that had very good starts of the year and now are actually coming a bit under pressure. Now, we have our short-term fair value model, which looks at a number of drivers and tells us whether currency pairs are trading in line with their short-term fair value. And we know that both for Euro NOK and Euro Stocky, those pairs are currently overvalued, and they are around the upper bound and the 1.5 standard deviation bands that generally signals that they are due a correction. So we think Euro NOK holds quite a lot of downside potential at the moment. We think that after cutting rates surprisingly in June, Norges Bank won't go so lightly in next decisions. They may shift a bit more on the hawkish side, and that can definitely help. But we think Euro Stocky is an even more compelling downside bet, because the markets continue to price in 25 basis points of easing by Riksbank. We actually think that there are good chances that Riksbank will not cut at all. From here, inflation may prove stickier than expected. Growth may prove more resilient than expected. And for this reason, we think that a return below 11 remains warranted in Euro Stocky. And since we've moved to Europe, maybe we can hand back to Chris to discuss the pound.
We've been slightly bearish on the pound, looking for euro sterling to move up to about 88 into 2026. The question is whether that comes earlier. And I think we're going to get some really important data tomorrow. I believe it is on the June, I believe it is labour market data. There's a big fall in May. If that figure is unrevised, and indeed there's a further big fall in June, I think that will push the Bank of England, it's working with kind of James Smith here in London. Obviously, the Bank of England very sensitive to the labour market, as is the Fed as well, and that could push the Bank of England into kind of early cuts. And of course, I think you've got to look at the fiscal situation, whereby Rachel Reeves is in a real bind at the moment, unable to cut welfare spending, as we found recently, trying to prevent or not sort of admit that they're going to have to raise taxes in November. Or the other option is sort of softening the fiscal rules, which obviously gilts won't like either, as will the market. So overall, we're mildly bearish on euro sterling, as I say, 88 into next year, but that could come sooner if the labour market deteriorates. But just wrapping up in the G10, if we look at the yen and the Swiss franc, I wondered if we could start off with a quick poll, actually, because in April, when we had those Liberation Day tariffs and the dollar kind of fell very sharply. Some of the big winners, it wasn't all about the yen, it was the Swiss franc and the euro as well. It looked like the market wanted liquid alternatives to the dollar. So let's ask a poll now. If we see another like Liberation Day style, loss of confidence in US asset markets, would which are the currencies outside of the dollar, of course? We assume there's a lot of confidence in the dollar. Will it be the euro, the yen, or the Swiss franc that investors will pile into? So let's hear your views. While you're answering that, just a few quick words. Dollar yen heading up to 150. We've got July upper house elections. It looks as like they have constrained PM Ashiba from being able to do a trade deal. There's lots of pressure to allow greater rice imports. But I think overall, if the dollar is coming lower as the Fed takes rates to neutral near 3 or 3.25 next year, dollar yen is going to have to play a role. We've got targets sort of under 140 towards the end of this year into kind of next year. So I think up near 150, I think the buy side will view that as a good region to raise for Japanese investors as well, still with US assets in the States, for them to kind of raise their hedge ratios. Regarding the Swiss franc itself, it's incredibly strong, right? We've got dollar Swiss under 80. We've got euro Swiss at 93. You can see the for reference, the trade weighted Swiss franc is very strong. But what's important for the Swiss National Bank is the real Swiss franc. So looking at the adjusted for inflation in Switzerland amongst its trading partners, and that's really strong as well. So we think they've got a problem with the strong Swiss franc. They don't admit it, perhaps because they're trying to do a trade deal with the States at the moment. But we think they're in a bit of a bind. They probably will try intervention, we would guess, around 92 to 92.50 in euro Swiss. That's our guess. Perhaps they will have to take rates below negative in September, but large-scale intervention is very difficult at the moment because they could be named a currency manipulator. And if we're right with the ECB cutting rates to 175 in September, I think euro Swiss stays pretty offered around here at 92, and we don't get that big pickup in euro Swiss until probably 2026. I think the second half of 2026, when the market might start to speculate over the first ECB hike as well. Could we actually just go back to the poll results actually for the safe haven question we just asked? So there we go. Let's just have a look there. So, okay, interesting that the yen really sort of out of favor with regards to kind of safe haven. So now we talked about the low yielders. We talked about Swiss franc and being very strong. And in Eastern Europe, it's the Czech crown that's very strong. So it's probably a good time to quickly go across to Franciszek Toporski and talk about the region. Over to you, Franciszek.
Yeah, hello, Chris. Well, the CE is actually doing quite well despite all this mess on the global level. So we can see the CE currencies are outperforming the EM and all other currencies, and the story is much more independent. So we can see the correlation with the usual drivers and the global factors is much lower than it used to be. And one of the reasons is probably the very strong local story. Another reason, obviously, is stronger euro, which is helping for the CE in general. But the local story is very strong. So we can see more and more divergence within the region. We can see very interesting stories on inflation, politics, and the central bank. So in general, the last few weeks and months were quite positive for CE. Now we think it's going to be a little bit more complicated. So I think we should have a similar poll for CE currencies. The question is actually what currency should be the strongest one at the end of this year. No pressure from my side, but I think it's going to be the Czech koruna because the story there is very unique compared to other countries in the region. We can see the economy is surprising to the upside all the time, basically in the last several months, and coming from very low expectations, market expectations here. The inflation is going higher or is above the target of the central bank, and the central bank is not very happy about it. So we think they're going to be hawkish, and altogether with the economy, we think this is basically the end of the cutting cycle. So the first country finishing the cutting cycle within the CEE, the people are still quite bearish on the economy and dovish on the central bank. So we think the change of these expectations will help koruna to continue in the current rally. So we think in the coming days we should test 24.60 and probably go lower in the rest of the year. On the other side of the CE, we have Poland, which is basically a completely opposite story to Czech Republic. The MBP central bank cut the rates surprisingly in July, started the cutting cycle earlier, which looking backward is quite understandable since the numbers were surprising to the downside from the economy, but from the inflation as well. The inflation profile changed a lot to the downside. So the cutting cycle was expected, just the MBP triggered or pressed the button a little bit earlier. But looking forward, we still expect lower inflation prints below the central bank forecast, and this should be pushing the lower or more dovish expectations, pushing the weaker currency, at least in the short term. So we think 430 probably could be the peak for the euro zloty. But in the medium term, still the Poland is a very strong economy, the strongest one in the CE region, quite strong fundamentals. So we still think the euro zloty should still stay on average for 425 this year. This altogether is kind of our conviction call for the CE. We think the zloty Czech should go lower as a best expression of the diverging stories within the region.
And actually, now would be a good time. Can we see the poll results, if that's okay, for the EMEA poll? Okay, so it looks like people are buying into your views there, Franciszek. And that's kind of strange, really, because like the forint, right, has been very popular on the kind of carry trade, right? I mean, what's your view there?
Yeah, Hungary, I think there was quite a lot of noise about the currency in especially the last few weeks. Still is the highest carry currency in the C3 space. I think the people like the lower volatility during the summer. As I've mentioned, also the C disconnected kind of from the global volatility, so we can see much calmer market here, and the summer should help. I think we are less bullish than the market is. We think the 400 per euro is already enough for a year and a half, and we think the second half of the year going to be more complicated. So we are more bearish on half. We think the economy is actually very weak, probably the weakest one at the moment in the CE region. We can see the surprises on the downside all the time. And the inflation during the summer probably should be a little bit lower. So people and the markets can get the feeling that the MBH cuts are coming. We think this is not the case, but still there is a room to price more rate cuts, especially after the recent hawkish repricing. So the dovish expectations from the central bank or about the central bank should be driving euro half higher in the rest of the year. So in the short term, we can stay around 400, but into the year end, we expect 410. In the rest of the region, I think the Eurozone, quite interesting story in Romania. We have a fiscal consolidation behind us, or announcement of the fiscal consolidation. Now the execution is the bigger question. But the FX-wise is much more interesting market than it used to be. We can see the Eurozone got much more flexibility from the central bank than in the past. Obviously, after the May sell-off, we seen the move above 5 level. Which is key for Romania, obviously. But now it's quite hard to guess where is the range. We've seen the 502 as a lower bound. Now 508 is probably the maximum what the central bank want to allow, at least in the short term. The fiscal consolidation is quite pro-inflationary, so we think the central bank going to be cautious about more FX weakness. So at least in the short term, we should stay in this range for 508. As a maximum, and probably just a little bit weakness into the year end. So we have 510 for the end of this year in the forecast. And the last one is Turkey, which is despite all the headlines, I think the currency story is still same for us. It's still a good carry trade. Obviously, the attractiveness is decreasing, and this story is coming to end very soon. But we don't expect any big spikes or changes, especially around the start or restart of the cutting cycle from the central bank. So we expect slow depreciation, but still quite good carry. And that's it from the CE. Back to Chris.
Great. Thanks very much, Franciszek. And yeah, without further ado, let's move on to Asia. Dipali.
Thanks, Chris. Before we get into the outlook for Asian currencies, can we do a quick poll on Asia, please? So which Asian currency do you believe has the strongest appreciation potential over the next 12 months? Got 5 options there. And while we wait for the poll results, let me run you through our key views on Asia. Of course, dollar appreciation has definitely played a role in Asia FX appreciation during the first half of the year. What we see overall is Asian currencies lagged behind their global peers, with a notable exception of a Taiwanese dollar, which was a standout performer. As we look ahead into the second half of the year, I think conditions will get tougher as tariffs begin to bite. And while Asian currencies would perhaps still continue to benefit from a weaker dollar, the overall view is the upside is likely to be limited. And what we would see is more differentiation across the region. The key drivers of this differentiation would be one, what's the progress on de-dollarization? Two, where the currencies sit in the valuation metric, and three, what the relative tariff rates might look like for the external balances for different economies. So if you first look at the broader picture, North Asian currencies still seem to have room to appreciate. From the valuation perspective, Chinese yuan, Japanese yen, and Korean won have room to appreciate. Sure, some of these earlier tailwinds for Taiwanese dollar and Korean won, like hedging demand from Taiwanese lifers or the NPS, have started to fade. In fact, a National Pension Service of Korea reportedly stopped hedging way back in early June. But what could still lend support, especially to Taiwanese dollar, is the strong export performance, which is something which will be a key factor that should not be overlooked. So for the Taiwanese dollar, we are looking for a move up to 28.5 by the end year. So still solid export momentum supported by semiconductors and computers. Moving on to Korean won, there are still a few supporting factors lining up. Bond inflows are looking strong, especially as the yield gap between the Fed and the Bank of Korea is narrowing. And on top of that, the domestic story is getting stronger. So the political uncertainty seems to be easing. And if Korea is in fact included in the world GBI, that could be a big positive for the bond inflows. So taking all of that into account, we do expect a Korean won also to appreciate to around 13.25 over the next 6 months. The CNY hasn't been making headlines lately, been pretty much range bound, but I think that could change as we get closer to the August tariff deadlines. And what's really notable there is how committed the PBOC is to keeping things steady, both on the upside and the downside. So we still hold the view that the pair trades between 7 to 7.40, and we see room for yuan to strengthen towards 7.13 over the next 6 months. JPY, I think, is perhaps the most interesting in North Asia. And when we talk about de-dollarization, Japan really stands out as an exception. So while China and Korea have been reducing their holdings of US securities, Japan has actually gone the other way, being a net buyer in the first 4 months of 2025. That suggests Japan is still very much aligned with the dollar system, and at least for now, de-dollarization is unlikely to lend huge support to JPY. We also have our poll results coming up, and JPY appears to be on top of the list, 51%, followed by TWD. So pretty much, I think the JPY argument in line with the undervaluation that we're seeing across the board on real exchange rates. But I think, like Chris pointed out, there is a bit of a period where it'll get tougher for a JPY. So in the near term, we are a bit bearish on a JPY. Quickly gleaning at South Asia, Singapore dollar has been one of the top performers, even though it looks overvalued, partly because Singapore faces relatively lower tariffs. We do expect this trend to fade off because there are strong reasons why MAS will go ahead with the monetary policy easing. So we expect the strength to fade out of Singapore dollar. Indian rupee still undervalued, and we expect it to benefit from foreign inflows. And what's particularly interesting for India is its recent exclusion from the US tariff letters, something which we think will lift overall investor sentiment and equity inflows. And really lastly, on Philippines peso and Indonesia rupiah, really the currencies where we are a bit less constructive. Right now, the recently announced tariffs on Philippines were larger than expected, and they are likely to add pressure to the already weak current account. And on top of that, the currency looks overvalued. And then these are also the economies dealing with the fiscal deficit challenges. So compared to others in the region, we'd be a bit more cautious here.
Okay, that's great. Thanks very much indeed, Dipali. Just wrapping up very quickly, let's have another poll, this time on Latin America. And it really touches on the factors, I think, that have been driving kind of Latin currencies. So if we could get the poll up on the screen. And it's some of those, the factors. Has it been, and will it be, in the second half of this year, will it be the carry trade? We've got 15% rates in Brazil, 8% rates in Mexico, very popular in quiet conditions. Is that going to be the biggest driver? Is it going to be somehow global demand surviving and picking up, lifting commodity prices? And obviously Latin region is very big for sort of metals, of course. Is it going to be issues like fiscal policy in Brazil with ahead of elections next year? Our domestic politics are really going to be the story. Or already we're getting the results here that tariffs, and I suppose that most recent 50% tariffs from President Trump on Brazil seem to be politically motivated. You guys think that that will be the biggest story. So in terms of just very quickly, I know we're running just 1 or 2 minutes over. Overall, we think probably Latin currency is going to be pretty steady. I've got sort of dollar real around sort of 570, 580. I think dollar Mexico doesn't manage to trade too much below 1850. Just Mexico isn't the amazing story it was kind of last year with all kind of FDIs, etc., and the tariff uncertainty. And I think perhaps one of the weakest in the region will probably be Chile with the copper story, because as Eva Menthi, our copper analyst, has been pointing out, those tariffs that have coming in have sucked in imports into states already, inflated copper prices, and now she thinks copper prices are going to come lower. And that's at a time when real interest rates in Chile are one of the lowest in the region. So I think probably dollar Chile can head back up to probably about 1,000 or so. Let's just quickly have 1 or 2 questions. I know we're 1 or 2 minutes over, but I'm going to go to you, Francesco, and ask probably sort of 2 related questions that appear in the public chat, and that's, couldn't the euro become globally weaker as EU signs are not that bullish? And again, what are the upside risks for the dollar? So perhaps you could talk about, Francesco, the risks that we get back to 110. How could we get back to 110?
Yeah, I think mentioning back sort of initial scenario analysis, the really return to 110 would be an environment where markets price out the risk premium that has built up since Trump came into office. I think it's really mostly up to what happens in the US. Normally we look at sort of euro dollar from both the US angle and the European angle, but I think what we've learned in the past 6 months is that really the US angle is completely predominant. So I would think that first of all we need to see the tariff story starting to deflate. This again can happen if Trump sees those inflation figures coming up, and his reaction is to try to wrap up any deals he can, and then sort of move on to gradually sort of sideline the whole tariff story and reduce the average US tariff rate on its imports. But on top of that, we obviously need to see sort of threats to Fed independence disappear, and sort of less political pressure ultimately allowing sort of the Fed to stay to keep rates higher for longer, because we've seen really in the past month or so how short-term rate differentials, and so the difference between Fed pricing and ECB pricing has really been the main driver for Eurodollar.
Okay, thanks very much, Francesco. I think in the interest of time, we're going to wrap it up here. Sorry that we can't get to many other questions we've got. But thank you so much for joining us today. Please check out our publications on ING Think, and we'll see you again next time. Many thanks.